No, yes, I got something delicious for you guys today. I decided to, wear a nice little suit, got a nice little shirt, clean, smelling good. And so before we start, just know that past performance does not dictate any future performance. So anything that has been recommended to you, from my opinion, just know that you do your own research, just for educational purposes only. Just covering my bases, covering my butt. And so also, before we start, like and subscribe to my channel. Share this content among the masses. I have a interesting topic, delicious topic for you guys today. We're going to talk about the dividend investing strategy for you guys to look into for you to be able to beat the market. And towards the end, I'm going to show you how I go about with my dividend investing strategy and see how am I doing, right? So if that intrigues you to know what are the different dividend investment strategies, how you can make money and make profit in the stock market. If you're interested in dividend investing, well, continue watch the video all the way through. This is going to be informative, great content that I would say guarantee that you don't want to miss. So for the first articles, it's like, so what is a dividend? So let's talk about how does dividend stocks work. Dividend stocks work where when you think of a company like Starbucks, McDonald's, Wendy's, Macy's, any type of business, ExxonMobil, Chevron, they particularly will pay out their profit to they pay out the profit and they give it to us as shareholders. So when you buy a particular stock of a company, of a business, let's say think of Starbucks, right? You have consumers going to buy Starbucks. They make a profit, net income. They pay their bills. Any surplus from like their free cash flow, they pay out the extra cash, extra net income to us as shareholders. And so with us as shareholders, we either can take that additional profit that they give to us. We have to pay the taxes since they transferring the cash to us. We have to take on the responsibility to pay the taxes. And just know that with that, you can either go through the route of either taking the cash to either option one, use those dividends to pay bills, or you can take those dividends, reinvest within the stock to buy more shares. And so this right here, it shows like what is a dividend. Here are some of the examples of dividend stocks: 3M, Procter and Gamble, Lowe's. And here's some key metrics that when you are interested in creating a dividend portfolio that you need to uh, take consideration. So dividend yield. So the dividend yield is inverse of the stock price. So the way to think of it is that so the annualized dividend yield represents a percentage of the stock price, like I said, and so and then another key metrics is to be on the lookout for the dividend payout ratio. This is the dividend as the percentage of the company's earnings. So when you're looking at particular stock and then in the metrics, you want the dividend payout ratio to be the sweet spot. Is normally let's say under 55% for the dividend payout ratio. And then other terms is total return, earnings per share, and most importantly, the PE ratio. The PE ratio is the price to earning ratio is calculated by dividing the company's share price by its earnings per share. And so high yield. Now, one particular dividend strategy that it's a niche that's in the dividend investing uh, sector is investing into high yields. It all depends on your time horizon. So if it's someone that's probably in their 50s, someone that's wanting to retire early, financial independence, retire early. If you're part of the fire movement or you're part of somebody that just want to use dividends to pay your bills, then a lot of times these group of individuals tend to lean towards stocks that are high yield, so or ETFs that are high yields like JEPI, ABR, mortgage REITs. But the rule of thumb is that the rule of thumb is to shy away from high yields, or don't have so many high yields in your portfolio, because the higher the dividend yield of the particular stock, the less of the opportunity for it to be able to grow in terms of share price, or um, depends on, you got to look at the dividend yield, because if it's a high dividend yield, odds are that sometimes, or more likely, that there may be some type of issues down the line in regards to the company, like when AT&T last year, I think what, 2020 or 2021, I forgot the year, when they slashed their dividend. So you have to be careful with stocks with high dividend yields. It's very profitable, very rewarding, but at the same time, it can get you in trouble. So just sometimes, you got to be on the lookout. How are dividends taxed? So there's many different type of there's many different type of stocks, like growth stocks, dividend stocks. Even in the realm of dividend investing, there's different strategies in regards to just to think about, where there's REITs, there's BDCs, MLPs, um, there's even, so then you got the another sector or category called qualified dividends. And so again, those stocks like ExxonMobil, Chevron, McDonald's, when they pay you the dividend, when you hold it for 1 year, that short-term capital gains move to more long-term capital gains, and then you become taxed more favorably. And when you tax more favorably, you're taxed on a tax rate of between 0 to about 20%, compared to at your regular income rates. And but then MLPs, like I said right here, MLPs, REITs, when you receive those type of dividends or distributions, they're not taxed favorably. So those are going to be taxed at your normal income rates. So whatever your income falls in on the income bracket, it adds to your income. So those MLPs, REITs, what was the other one? BDCs. When you buy those type of stocks, those stocks are not, those distributions are not contributed into very tax advantage way. So just keep that in mind. So right here, dividend investing strategies. Ooh, you know, right here it says, there's a misconception that dividend stocks are only for retirees or risk averse, but we right here, we have built a whole community, a whole way of thinking with dividend investing, dividend growth investing, where a lot of individuals feel like, you know, by investing only into dividends that they're not going to grow, they're not going to grow as fast as a Tesla or Amazon, but that's not true. And I can show you, because there's many different high growth dividend stocks that actually also pay a dividend, but also grow your portfolio by a lot. Next, what I'm going to talk about is I'm going to get right into the meat and potatoes of the actual video. So the if you're a new investor, if you are a beginner investor, I know you want to learn, like, okay, Kadero, in your past videos, you talked about how to use dividend stocks to make money, $50 per month, $100 per month. Now I want to create a dividend portfolio. Now I have a nice little portfolio of maybe 5 to 10, 15 stocks. Which way can you help me? Which way? What different dividend strategies? Let's talk about it. The 3 dividend strategies for you to sit down and think about is: one, either go down the high dividend income route. So when you do the high dividend income route, it's low growth. Like I told you in a previous article, in terms of high yielders. The second route is high growth, low dividend income. So typically these are for individuals who they have years enough to produce a large portfolio. Like if the individual started in their 20s, 25, maybe 30, they don't want to have a huge dividend portfolio, because they know that they probably don't have the means to pay the taxes on it. So they want to grow a large portfolio, but at the same time not have to pay a lot of taxes. They go with the whole high growth and low dividend income route. Still dividend income, but just low, like Apple and Microsoft, low yielders, dividend stocks with yields lower than 2%. And then the last dividend investing strategy is the balanced growth and dividend income route. And lastly, after I go through this, I'm going to go over my particular strategy and how I, even last year when the market was down, um, negative 22%, I was up, I want to say 4% for a entire year. So, we go through my portfolio and to show like how I was able to beat the market last year. Not saying I beat the market every year, but I incorporate my little strategy. So I'm just gonna let you know how I do it. So right here, what type of stocks are a good fit for a dividend investing strategy? Number one, which is the high yielders. Basically, master limited partnership REITs, real estate investment trusts. Uh, high yielders are like Mo, the Ultra Group, which is the cigarette company, has a operating with cash rich, where even though we know that the tobacco industry it's a dying industry, but you can get a lot of high yielders, 8%, 9% from Mo, Ultra Group, uh, Philip Morris, BTI, British American Tobacco, I believe. Don't crucify me. And so with the first route, the pros of a high dividend portfolio is you earn high amounts of dividends and income. You can invest in uh, proven companies that have been around for a long time, and you can rely on less share price movement. And so also another pro that I'm not going to put on there is that you can use those dividends to pay your bills. You can use those dividends to actually live off of in retirement, and then also uh, those dividends really help in terms of compounding, where you can build up that particular stock or portfolio, and then once you build that up, then you can use leverage. You can use as leverage to use those dividends to start a new position, either with a new stock, new ETF, or new positions. But so cons are with the high dividend strategy, high yielder dividend strategy, is higher chance of dividend reductions. I told you with the example of AT&T slashing their dividend. Dividend growth may not keep up with inflation. So what happens is that these high yield stocks, where uh, this 8%, 9% is good for now, but at the same time, when you only receiving just 8%, 9%, that's good. But then after a while, you're not going to be able to keep up with inflation because your money is not growing. It's just you just think of uh, think of a like annuity. Annuity, you take $250,000, and you're going to get that same amount of money at that percent, at 5%, at 6%. In this case, if you get a stock that's like only 8% at 10%, that's good. But as the time go past 5, 10 years, you want your money also to grow. You want the portfolio or your dividend increases to increase as well. Because otherwise, your money will be eroded from inflation, because inflation is going to continue to go up. Things are going to continue to be expensive, like eggs, steak, chicken. Chicken's already expensive. Chicken wings are already expensive. You used to get Buffalo Wild Wings on a cheaper price. Now, it's madness. And then also higher tax liability. So if you don't have the means to pay taxes, or you want to eliminate paying taxes right now in a taxable account, then try to shy away from putting too many high yielders in your particular taxable account. But if you want to put into like a tax advantage account, like a Roth IRA or a traditional IRA, be my guest. You can put your high yielders in there, and you'll be great. But for individuals who want to retire early, make income, use dividends to pay bills, or grow a portfolio where you can use to travel, go to Jamaica, go to Panama, go to Sweden, then you're just going to have to eat that cost of paying taxes by investing in high yielders. So now, uh, who and so first off, it says who is it suitable for? So it's suitable for anyone who wants to maximize their cash flow for dividends. Right now, I told you, retirees, people who want to utilize their funds to pay bills. Uh, it just makes sense, right? So let's talk about dividend strategy number 2, dose. Let's do it. Hey. And so, high growth, low yield, low dividend income. And so this is for individuals who have 20 plus years to grow their particular portfolio. Think of like think of index funds. Think of low yielding stocks like Microsoft, Apple, Lam Research, KLAC. These lows. These are the different type of stocks where the dividend yield is under 2%, so it's low, but it grows the dividend at a higher clip at 10%, 15, 20, 25%. And then also the company participates in buyback. Oh, I forgot about Apple and Microsoft, if I haven't said that. It increases the share price by a lot through share buybacks and just overall by the company being so profitable, it take in a lot of the profit, which also shoots the share price up. So it's paying you a lower dividend, but the dividend increases that they increase on an annualized basis is huge. The share price increases, and then they also do share buybacks, which also increases the price. So usually people use this when they have like a lot of time to grow their portfolio, and so they want to not pay not a lot of taxes because Microsoft, Apple, uh, Lowe's, they do pay a dividend, but it's not anything substantial as a stock or ETF that or income fund that pays 8%, 10%, 12% dividend yield. These are 2%, 1.5%. So like almost like maybe like 67% less. But at the same time, your portfolio is gonna grow at a higher clip the more you invest in those stocks or ETFs like VU, Apple, and Microsoft. And so let's go with the pros and cons. The pros is that it's a good opportunity for share price increases. Told you that. Great opportunity to minimize tax liability because you're going to be paying less taxes overall because the dividend yields is uh, quite fewer. And then most importantly, the dividend increases will outpace inflation because they tend to increase the dividend 15%, 20%. And that's usually sometimes like 2 to 3 times inflation because inflation traditionally is historically, that's the word, it's normally only around 3.5%. So and right now even the inflation is just beginning to tick down. The CPI data, PPI data as well. And this strategy is best for someone that doesn't need to rely on their dividends right now because you can tend to grow this huge portfolio. And then as you get towards retirement, you can sell off the portfolio and put it into what? High yielders. So keep that in mind. And then the last strategy is the balanced growth and dividend income strategy. So it needs no introduction. It's basically a blend of having high yielders, having high yield stocks of 8 to 10, 12%, and then having low yielders of 2.5, 1.5% that's going to grow your portfolio. Have a portfolio in the mix, and then combine. And with this approach is that you don't take a stance of I just want to be just a growth investor, or I just want to be a high yielder. Why not do both? And so uh, in the next screen or in the next article or what we're going to talk about is going to show you my particular strategy, how I'm going to go about doing it. So how I'm going to go about doing it is that for 2023, I plan on, so right here you will see JEPI is an income fund. Enbridge is a high yielder stock. So EPD is a high yield stock. So right here, for my particular strategy, I choose the blended method, and I plan to blend my high yielders with my low yielding stocks, as you see. And for me, if you look if you look at my portfolio, ta-da! So in my dividend portfolio, and this is a great site to do research on stocks and your portfolio is called Simply Safe Dividends. And with Simply Safe Dividends, it tells you well your portfolio growth rate. My portfolio dividend growth investing portfolio uh, growth rate is 12%. I'm highly not diversified. My beta is 0.83. The market is one. So the closer you get to one means how closely related you are to the market. And most importantly, my dividend portfolio is safe. So here's another option. So I went through the diversification of my portfolio, that did my portfolio dividend growth, and I'm going to click right here, dividend safety score. So what what I love about Simply Safe Dividends compared to other dividend trackers and other dividend researching portfolios and sites is that it takes the stocks that you invest in your portfolio, and it actually would do the research and show you like the likelihood of it breaks down your income of each stock of what it's paying you, and then also it gives a particular score. Of course, the higher the score, the higher it shows you that of your income and the company it being safe. So the lower you just got to keep a watchful eye on the stocks that are on a little bit lower because that means that if a recession continues to go on, or the higher the percentage for that particular company to be able to will be able to default on actually paying the dividend. And so a lot of times, uh, you want your dividend income of roughly, maybe 80% in the likely safe, so that when you get into retirement, you can be able to sleep better at night. For me, by me being 34, only having three, four, five, only having about five stocks, maybe six stocks, and the likely safe, it's completely fine with me because a lot of these companies have been around for a long time. But yes, if you have the money and the means to, definitely invest into Simply Safe Dividends for their dividend safety score. But overall, for me, my dividend portfolio right here, I've gotten a couple dividend increases in the last couple of days. TSCO, Tractor Supply, increased their dividend by 12%. And then T Row, understand this, it's an asset management company. It raised the dividend this year about 1.7%. I'm not really worried because I'm surprised they even just paid a dividend compared to a lot of people taking out a lot of money when the market has been down. But uh, the CPI data is looking good, PPI data is looking good, and for me, I tend to go through in the strategy of the blended. So right here, if you look here, I have one, two, three. I have one, two, three, four, five, six. So I have about six stocks of my 31 stock portfolio that are high yielders. So of course, as I told you, the high yielders you have to just worry. They don't tend to, as you look right here, they don't tend to grow as fast as the low yielders. But the high yielders are the ones that give my portfolio the punch it needs in terms of boom, give you the punch it needs in terms of the dividends. But right here, the low yielder is going to be at the bottom. Right here, it shows right here under 2%. You got Starbucks, Tractor Supply, United Healthcare. You have Lamb Research, and these right here tend to offer a lower dividends, but the growth you see right here 12%, 14%, 15%, 24%. Then I also have, stocks in between that serves my needs. And always remember, do the research on the stocks that you want, rather it's through Simply Save Dividends, Seeking Alpha. I'm just here just to let you know of the different methods: the high yield method, the low yield method to grow the overall stock or dividend portfolio, or you could take the blended method. And for me, by me taking the blended method, I was able to beat the market last year. Not going to say I'm going to beat the market every year. Not going to say that. I'm not a financial advisor. This is just, my opinion and my expertise. I've been investing for about 6 years now, continue investing. I choose the dividend growth path. I choose dividends that grow, dividend aristocrats, dividend contenders, dividend champions, and my dividend investing have not steered me wrong. It has made me money. I've been growing. My portfolio has been growing at a 12%, 15% annualized returns clip. And even last year, I'm towards the end of the year when the market was down, I was positive 4%, 3.5%, 4%. So you don't have to, believe what I gotta say. Just believe, my portfolio and me stick to the path, putting in roughly $550, $800 per month for me. You can do $250, and you can do it. If you enjoy this content, like and subscribe to my channel, share this content, and hopefully you come back for the next video. Hopefully you stay throughout the whole video to understand the different strategies. Hopefully you enjoy the blended method. I like the blended method, but if you like low yields stocks, then go for it. If you like high yield stocks because you want to pay your bills now, or you're ready to retire, or you want to retire early, be my guest. But I'm just here to just help out. All right, guys, you have a good day.